So I'm going to introduce the chair, and then the chair is going to introduce the panelists, who are each going to say a little bit about themselves during the discussion. So the chair for our panel is Dr. Dan Rosen. Dan is an internationally recognized quant and fintech entrepreneur and an adjunct professor of mathematical finance at the University of Toronto, and was the first director of the Center for Financial Institutions at the Fields Institute. He has worked with numerous financial institutions around the world, lectures extensively on risk and portfolio management, financial engineering, and fintech innovation, and has authored numerous research publications and several patents. In 2010, he was inducted a fellow of the Fields Institute for his outstanding contributions to the Fields Institute, its programs, and to the Canadian mathematical community. Dan was the co-founder and CEO of R-Squared Financial Technologies, acquired by S&P Capital IQ in 2012. Prior to that, he was part of the executive team at Algorithmics, where he had a successful career over a decade. Dan holds an MASc and PhD in chemical engineering from the University of Toronto. Pass things over to you.
Thank you. Over there. So thanks everyone for attending today, and thanks to the distinguished panel that we have. Over these 3 days, we've been discussing the applications of quantitative methods to wealth management, and the goal for this roundtable is to bring in some practitioners, some people who actually have been working for quite a significant period directly in industry, applying and figuring out how financial advisors and wealth management firms use analytics. So really what we want to do today is just explore what is the state of wealth tech, what are some of the most interesting questions and applications for quantitative methods, what are some of the challenges, what might be a hype or not a hype, perhaps touch a little bit about robos versus humans and some interesting science fiction topics as well. So what I'll do very quickly, and I'll ask each of you maybe to introduce yourselves. So maybe starting beside me is Ken Lotocki, and Ken is responsible for the product direction of Conquest Financial Planning. So Ken, perhaps you can spend a couple of minutes talking about you and your experience and what you do for a living. And
sure. Yeah.
And
so Ken Lotocki, Chief Product Officer of Conquest. I'm part of the founding group. For those who aren't familiar, Conquest is a financial planning software or financial advice software. So we sell primarily to large enterprises and wealth management shops and so on to basically use our software to model complex financial plans and project them forward into the future. I've been in the space for about 17 or potentially more, working with a company called EISI, where I started my career. We built Navaplan. So if anyone's in the financial planning space or got a financial plan from pretty much any of the providers in Canada, it's probably been a Navaplan plan. We sold that in 2011, 2012. I stayed on with the owners who bought it for a few years, and then left in early 2018, and where we kind of got the original founders of Navaplan back together, had some conversations about the fact that wealth tech in general is kind of why we're here, right? It's kind of was stagnant, lack of innovation. A lot of things are the same. Typically, a lot of the tools that are out there prior to us were what we call trial and error planning, which is heavily dependent on the user to know what they're doing to build a plan for a client, which, as you'd imagine, tends to cause things like advisor bias or building things that are not in the best interest of the client, sometimes pushing a product without understanding their holistic situation. And with Conquest, we are actually our president and CEO. He is a PhD from the University of Manitoba in Winnipeg in distributed AI. And so when we started talking what we could do, our conversation started to root around the fact that with where technology is today, how can we leverage artificial intelligence? How can we eventually leverage machine learning? How can we do something better to essentially make the ability to build a financial plan for an advisor more efficient and more effective? We've used some analogies with our tool. Our engine, we call it SAM, is the caddy to the advisor who's a golfer who's going to actually hit the shot. We're providing scenarios and different options in terms of how to build and approach financial planning. And we've been in business since 2018. We're recently been relatively successful in Canada so far. One of our biggest recent contracts is Royal Bank, but we work with firms like Wealthsimple, Investors Group, Canada Life, Manulife, all the lives in Canada. Recently launched in the UK and are in the process of launching in the US. So Thanks for having me here, Dan.
Relatively successful. Pretty high bar.
Thanks, Ken. Next to Ken is Jason Pereira. And Jason is a very accomplished financial planner. He's an industry advocate. He's a preeminent expert in financial technology, and he writes he's a columnist for the Globe and Mail, for the Global Advisor. I think it's important. He's also the founding president of the Financial Planning Association of Canada. So, Jason, tell us a little bit about you, what you do.
Besides why I'm here, despite all that stuff, besides being a practitioner using all this, I have firmly inserted myself in the fintech spectrum by basically working as an advisor, a consultant, a user tester, you name it. And I've been running a podcast called Fintech Impact that's over 270 episodes long now, where I've interviewed founders of people, all three people on this table, about what it is they're doing, and really kind of built a deep understanding of what the sector looks like around the world. Of course, that has led to, like I said, advisory board positions and consulting gigs and whatnot, as well as speaking and advocating on behalf of digital transformation in Canada, the US, and I think the UK have done some sessions there too. So, so yeah, that's why I'm here. I'm kind of fitting that interesting Venn diagram of technical practitioners who understand what they're doing, and then the technology aspect overlay to that. And I find that very few of us occupying that middle space in the Venn diagram.
Great. Thanks, Jason. And last but not least is Pauline Shum Nolan. And Pauline is a professor of finance at the Schulich School of Business, and she's the founder and CEO of WealthScope.
So like many of you, I've been an academic for, well, maybe not like many of you, I've been an academic for a very long time. I started at Schulich School in 1998. I've been teaching portfolio management and investment in a lot of the CFA curriculum. I've been on the York University Pension Fund Investment Committee for the last 20 years. And so founding the business was really from a personal pain point. For those of you in Canada, you remember 2015, 2016, the price of oil. There was a lot of trouble. And we asked at the pension plan, we hired very expensive consultants. So we asked the consultants, should we be worried the fund? What's our exposure to oil? And so the response that we got was that, yes, you have some equity names in energy, and you have some infrastructure projects in energy. And so we were saying, okay, well, then should we be worried? What is our net exposure? Because obviously we diversify, right? So we weren't able to get an answer. And in general, if you are just several billions up to several tens of billions pension plan, you are relying very heavily on consultants. And from the consultant's perspective, they give you a lot of detailed information for individual products, individual funds, down to the fund manager, how many kids they have. But at the portfolio level, something was really lacking. I mean, we all teach. I mean, looking at the agenda for this conference, a lot of it is about what happens at the portfolio level. And so that's the sort of the genesis of WealthScope. We provide on-demand portfolio analysis as well as research tools. A lot of what we're working on in machine learning, and so the public don't have access to. So we build the tools where we're applying a lot of what I'm doing research on with my PhD students, what we know about, but do it in a very intuitive ways. And that is another thing that I find really lacking with a lot of the institutional products are very difficult to understand, even if you have a CFA, right? That are typically very legacy looking, you know, they have the sort of the column here where you pick, and so just looking for certain information is very texting. So that's what I try to contribute to.
So I actually find it fascinating, Pauline. From our side, like when I started Digit, like we joke that, and it became a tagline that we use now, that we build the wealth management platform that we wanted our advisors to use. Because for me, it was always the big problem. Like I couldn't aggregate all the accounts that I have. I have 2 kids with RESPs and RRSPs and tax saving accounts and all that. And for my life, I had a spreadsheet that I was updating by hand, and one of my co-founders, Benoit, who's the head of product, had his own spreadsheet that he was building, and we're all comparing. like how do we go? And I was just trying to answer the question, how much am I invested in equities across all my accounts? Question I couldn't answer. I truly, my financial advisor couldn't answer it. And it's not that complicated. I mean, forget risk. I wanted to get risk. I'm a risk guy. Yeah. But that to me was one of the motivators on doing it, and when we saw the pain point. What I'll do, and I'll make sure that I'll open the floor for questions from the audience and also online. But maybe let me start with a couple of questions for each of you, and I'd like to start with Ken, because Ken, you've been doing this since, I mean, as you say, for 15 plus years, and you've seen how financial advice planning technology has evolved from what you were building in the 2000s to where you are today. And how has the focus on the practice of financial planning evolved, and what's the role of quantitative methods, and what do you see?
For sure. So it's funny you mentioned Excel. A lot of the older tools that are out there, so even Naviplan, like if you at the heart of it, it's an Excel file beneath it. I mean, obviously there's things like taxes and reallocation of portfolio and all those things that you build into these things over time. But that was really how tools worked in the early 2000s. That's what financial planners had access to. And as I was mentioning kind of in my opening, even Naviplan, what it was a trial and error based system that the advisor had an area to go to and try different things on their own. And the system would only give you feedback in terms of a number goes up or a number changes and so on. So the complexity or the contextual compounding of different things that you could do in a plan, whether it's focusing on assets or focusing on saving more or retiring earlier, was just very, very onerous. There was a study that was done in 2019 by a fellow out of the US, Michael Keatses, who said it takes 10 to 17 hours to build a financial plan in incumbent technology today. And that was a stat that stuck with us because we built that tool. We built an in-home Monte Carlo analysis into our application that was used. It was not understood by any single client out there. In fact, we always made the joke, it was the Anchorman approach to stochastic analysis, which is 60% of the time, works every time. And that's literally what the report would say. And so where are we seeing the shift and why we're changing things now, and I'll talk a little bit about what we're doing with stochastic numbers in Conquest, is more and more clients the end consumer wants to know, what the heck am I supposed to do? What's the value of advice? Why am I going to see a financial planner? There's been issues worldwide as well that just there's a lack of a financial advice that is out there for anybody unless you're in the high net worth space. So if you have millions of dollars, chances you're a financial advisor. If you're in the mass market, mass affluent space, nope, you probably don't unless you're very diligent and you've gone and specifically asked for that. So with Conquest, a few goals that we set out was we need to make it easier and more effective, as I mentioned, for an advisor to plan. So that's where we built an expert system. It is rooted in AI that we call SAM, who, as I mentioned, acts as the caddy to the advisor's golfer and helps build a plan by suggesting the next best financial decision contextual to the client situation. And those strategies can range from something as simple as reallocate your portfolio to something that's in line with your risk tolerance, coming out of a risk tolerance questionnaire. It could be something more complex, such as, there's a different age in spouses, consider a spousal loan, or potentially, take risks earlier or use your younger spouse your age for minimums. All of these things get factored in, stuff that in traditional technology, people will have to hunt for. The second big thing that we did was on the actual user interface and the ability to do it. So with more and more clients wanting to know what the heck they're getting, we built a very intuitive user interface to allow a client to basically see and understand, what am I looking at? Like, what does it mean if I sell my house later? What does it mean if I save more to my RSP versus my TFSA? What does it mean if I go 80% equities instead of, we used to see some clients who would be, literally they're all in GICs because they're scared, they didn't understand, and that's the safe thing to do. But now we can visually demonstrate the value of going into more diverse portfolios and things like that in a way that when the advisor is working with the client, because we still want the expert involved, they can see it and understand it. So then what we decided to do with all of that was look at things from the quantitative perspective and the stochastic analysis, which is how do we get away from a percentage number coming back saying, out of everything that we looked at, everything that we built, what's the best way to communicate volatility, to communicate risk, to communicate variability in portfolios. And so This time, what we did is we built an analysis that takes 1,000 different market simulations that are built for us based on historical performance and uses historical performance and other economic factors to construct these simulations. We apply them to each individual asset class, capital market assumption portfolio in the application. We run that, as I said 1,000 times. It actually, there's over 800,000 to 1 million different data points that could come up. And we basically present the plan back to the client, which traditionally when you're building it's deterministically, because the client's going to anchor on that return rate. And now it comes back and we can tell them the age in which your portfolio starts to become most risky based on where you're in, the range of outcomes. And so you have the conversation about, if you're in this 100% equity portfolio, you could have anywhere from, $1,000 to $10 million, right? But you can have that communication with them. But more specifically, you can start talking to them about how do you mitigate the risk in their portfolio and do that in a way that's very visual, very easy for a client to interact. We can share it with them, they can get it, provide financial literacy and work through it. And so our goal was to build a better system to make it more effective for folks like Jason to communicate those plans to clients so they can understand all the complex nuances that come with building a holistic financial projection.
So Jason, in addition to financial planning, what do you think are other areas where technology and some of these quantitative methods are needed or will have the biggest impact on advisor practice?
That's a good question. Okay, so let's understand the landscape as it is today, right? So the US being the biggest market for this, most of the technology that was developed for them came about in the early 2000s. So a lot of what they're dealing with is legacy, hard to evolve. And a lot of it was, purpose-built for not necessarily large quantitative solutions, but base advisor needs, right? In Canada, we were a laggard for a long time and continue to be, but that said, innovative companies like Conquest and others in Digit and as well. So innovative companies like the people basically built modern technology that is actually generations ahead of what we're seeing elsewhere. But they've also done something different in that, they weren't going to go and compete at base level needs of deterministic financial plans or aggregating certain information around portfolio statements or, trying to be Morningstar what Morningstar does. What they did was they brought together two very vital components. They brought together sensational UX experience, which was one of the weak spots in all the tech I saw elsewhere. It was very brutal, it was very engineered, it wasn't very user-friendly. It definitely did not, ever hire an Apple engineer to work on UX. Okay, that just never happened. Whereas now what we're seeing is far more user-friendly tools that I'm actually comfortable putting in front of a client because they're understandable. And they actually allow me to create a dynamic and collaborative interaction with the client. That's the first one. But then let's get to the quantitative side. The quantitative side is that basically they've also brought forth a lot of these more advanced methodologies for portfolio attribution, for financial planning, for vetting of different performance indicators from different vendors and portfolios. And they brought that to the forefront, but they've done so in a way that does not overwhelm, in a way that's approachable, in a way that's explainable, in a way that's visual. So they've married both those and created, I think, an advantage over what exists in the marketplace that has been dominant today. And here's the other thing too. And that's not going to surprise many of you, but quite honestly, most financial planners are not big quants, right? So a lot of the stuff we're talking about here in terms of stochastic testing, in terms of things like Sortino ratios and basically figuring out how this all compiles into a portfolio in terms of attribution down to sectors, like those were things that, they have heard those terms. Do they understand the math behind it? Probably not. Or maybe they looked at it once and never looked at it again. What the key, and that's a lot of, because of that, a lot of the reason that the existing marketplace was not meeting those, bringing that quantitative stuff to the forefront was because they weren't being asked for. Whereas now what's happening in this new generation is that these quantitative methods are being brought to the forefront in a way that is not only easy for the client to understand, but also easy for that advisor who maybe has some idea what they are, to see value in them, to be able to relay it, to actually demonstrate value of knowledge to the client and do so in a way that's not overly burdensome of their time. So, and letting them focus primarily on the client relationship, which is really the direction the industry's headed.
I really interesting comment, because one of the things we found after a few years preaching on some methods like scenario analysis, which are pretty well used in institutional settings, was advisors were telling us, no, we don't use that. Our clients are not sophisticated. We're not sophisticated. But I think most of the time is because they didn't have it in a way that was usable. It was just not. So, for example, now with the whole pandemic and the crisis, we have now clients saying, what happened with those scenarios? Like, I would love to be able to go and show my clients that actually every crisis that happens, there's actually a recovery period. It does happen, and the worst, and I mean, we saw it in one of the talks yesterday. The worst thing you can do is go and sell everything. The real thing you need to do is go and rebalance your portfolio in the right way, thinking you're going to come out. And it's just that thing that makes it complicated because people don't have it or don't have it in a way that doesn't look like a trader's Bloomberg platform that's very specialized.
Combination. Take a look at what a financial advisor versus institutional investor looks like.
Yeah.
Right? Their life is far more burdened by administration because we're dealing by death by 1,000 cuts. You know, number of, even if it's 100 households you're dealing with, it's probably in the neighborhood of probably over 700 accounts, right? So multiply the amount of administrative burden, that's their day. Then as for the entire, well, you know, my clients don't care about that. Look, that says more about the advisor than it does about your clients, right? And more often than not, it's humans are not good at change, right? Especially busy humans. But the reality is that those who basically do take what you've all developed, bring it to the forefront, are having deeper, more meaningful conversations that explain what actually happened. And I think what you're seeing is that the early adopter stage is near the end, right? At least for many, depending on where you sell in the marketplace. And what you're starting to see is more best practice. You're becoming best practice. It's, hey, I'm not showing you a PDF of the statement. I'm leading you through a journey, you know, through Digit to explain, here's what your portfolio did, here's how it's positioned, here's what contributed to the downsides, here's the scenario analysis, and be able to tell a narrative in an approachable way that is also letting the client call the shots on, okay, that's fine, but like my kid's going to school next year. Okay, but we didn't do that with your kid's school portfolio. Let's dig into it and let me show you the same information, right? It's turning that conversation to something dynamic. And as I often say to advisors when they always fight back and say, well, my clients are going to use this. My response is, A, did you survey them? Because the answer is no. And B, if 80% of them use it, think about the incredible gain you get from that. And just human nature.
For sure. As we move, and definitely one topic I keep hearing back, and particularly from VCs and investors, we just finished raising a round of financing in these very difficult conditions, but I still survived. But one of the things that really puzzled me is I couldn't go to talk to a VC without them telling me, what about AI? And are you an AI company? And my point is, sure, we do some AI, we do machine learning, we run regressions, and we run regressions with Lasso, and we do a lot of very, very interesting things, and we do dynamic programming, and we solve all these things. But I always thought that the way they're viewing it, and there's of course pressure with a lot of these things. So Pauline, on your side, what would be good use cases for machine learning AI? Where is there some hype, and maybe that I'll open it to everyone for also commenting.
Sure, so I simplified that. In my case, she was an economics, and so obviously I took a lot of econometrics, but it's only recently that last few years I heard about the OLS algorithm. So to the relationship, my engineers have had to be too specific with this. Yeah, that's very interesting. With wealth management, I think my colleagues here on the panel would agree that a lot of what's happening in wealth is still about automation. Okay, so let alone, sort of AI. But so when it comes to AI, then I mean the most important thing is what are the use cases, right? You've all heard about ChatGPT spitting out like things and responses that are actually not factual, right? So therefore, it's very important about thinking about the right application. And for me, I'm going to completely in my courses revamp my assignments, because do we go against the grain? Because that's GPT-0, turn it in, that some of you may use, are coming out with this detection tool. But do we want to go against it Or do we want to sort of raise that this is just the facts, right? And change the way we give assignments and assess the students. So one application that I see that is legit, if I may use that word, is a classification. So you know that, I mean, BERT came out in 2018 from Google. In finance, that's been BERT, that is trained on corporate time theory reports data sets. One of my PhD students are working with social media. So investor comments, user comments on Wall Street Bets and other social media, and they speak very differently. So therefore he hand labels. So this is the thing with natural language processing up until ChatGPT is that you need to have label data to train, right? So this is 18 months ago, he hand labeled 12,000 user comments from investing.com, right? And then it performed better than BERT for sure, and just a raw BERT. And he spent a lot of time on that, right? So yes, with the model, then we can go classify millions of comments very quickly. And then when ChatGPT came out, we just thought, okay, well, how good is ChatGPT in classification? So we did a test. We took a sample of the user comments, the posts that we have, and actually, believe it or not, ChatGPT is pretty good. And not only, so the handle label data that we did manually, it's just a relevant comment for investing. If so, is it bullish, bearish, or neutral? Right? This is a limit to how much we can label. But ChatGPT, they can have additional sentiments like fear, like whatever. So far preliminary, but a preliminary result that we find is that it actually doesn't. This is not for, I actually don't have access to for yet, the API. So the ChatGPT 3.5 Turbo. So with that, this still older API, we're finding that it has pretty accurate results in terms of classification. So therefore, that I think that is a good way. And of course, they are, if you're worried about non-factual results. Morningstar, we're talking Morningstar earlier, they came out with Mo, I think that's the name of their chatbot. But what they do is that they went to Microsoft and they are only letting their bot access Morningstar database. So therefore, it is not an innovation as such, but it's more convenience, right? So for example, if you look at any ETF screener, stock screener, so we would say, if you want to look for asset allocation ETF, you are currently at the mercy of the construction and UI UX of what is the, how it's not that easy to find an asset allocation ETF because it's not equity, it's not fixed income. It might be an alternative, but it differs from one screener to another. But with a bot, what you can do is that I want to give me, top 3 by AUM conservative asset allocation ETFs. Boom, we have that. So again, I think the most important part, 2 things is the use cases, as well as obviously your worker that's a prompt engineering. Again, we're testing a lot of what to put in those prompts because we're building our own as well. So I'll stop there. I mean, you hear a question, I'll be happy to answer that.
Anything to add, guys?
Yeah, actually, it's funny enough, I just actually did a podcast on financial advisor artificial intelligence today, and I would say, yeah, the use cases right now, I see a handful, I don't see a ton, right? I do believe that every major advisor technology platform in the US will have some implementation of ChatGPT internally to it within the next 24 months, primarily as a replacement for customer service bots, right? Or education vehicles, right? So we'll be able to retrieve that information, serve it up, because it's a relatively easy lift. That said, I've also signed up to work with a company called Cypha out of the UK that is working to integrate into different platforms and be an artificial intelligence chat layer over top of all the different systems. It would be nice if all these different disparate systems all access one core common data architecture. That's never going to happen. I've been hearing about this complaint for over a decade at conferences. No one's got a solution. They just keep on saying we need a solution. So I think that this is nice because it sits over top of it. And what the idea is that it will allow us to basically connect information on similar clients that's structured in different ways and be able to ask in one place, what is going on here? Compile profiles. So simply something as simple as, hey, my one system for onboarding has a bunch of information. My financial planning system has a bunch of information. I want to know, when is this person's mortgage up for renewal? I can ask that in the chat and boom, it will search all the certain, I'll search for it and pull it back. So I don't need to know where it's siloed, right? There's a use case. There's a use case for dealing with the disparate sources of data. But that said, I think that we're going to see a lot of very simple implementations in the next 24 months. We're going to see a lot of people figure it out. We're going to see a couple of competitors to what Cypher is doing. But I will say that I think it's not chat, but actually I've seen your chat implementation, but I think some of the more exciting artificial intelligence. I use quotation marks because, right, the line is constantly moving on what we consider AI, right? It's like what is the saying about anything, any science that is that different basically from what we understand is like been the magic in a lot of people's eyes or something. I'm butchering that saying, but I feel like there's a lot of arguing going on about what constitutes an AI and doesn't matter. What matters is that I be able to make a request and the machine figures it out, full stop, right? I think one of the more smarter implementations I've seen across the board has been what you guys have done at Conquest. So overall, look, I'm not surprised, Dan, that you got that question because VCs are equally as prone to buzzwords and things going on and trends as everybody else is, and everybody wants to fund AI because there's easy money there. And we had a seminal moment with the introduction of ChatGPT. That was a moment in technological history where it captured the imagination of the world, right? So I'm not surprised. But I still am waiting to see a couple of killer apps on this. And so far, I've only seen a couple, which I think are really, really valuable within specific verticals, and a couple that are generally widely valuable.
And as Jason noted, like for us as a technology provider, our specific use case has always been to make the software easier for the advisor and for the end client to understand. So our initial research, we did connect to ChatGPT. We're in ChatGPT 4 right now. The first thing is, as soon as we started talking about it with every bank was, oh God, please don't. Like that.
I would love to hear
The biggest thing was there's two things. First thing is security teams losing their mind. So obviously when we use it, we're not going to go to the internet. We're not going to search this thing. We have enough data and calculations in our engine for the large language models to make use of it. The second thing is, and this happened when we first rolled out Conquest, is this going to replace our advisors? Like, do we need them now? Right. And in both answers is like, no, right? Like the advisor is important. It's like if you put ChatGPT into WebMD, just because you can speak to it and it can give you a diagnosis back, you still need a medical professional to step in, right? Financial planning is the exact same, right? The more complex the plan, the more value it is to have a human. So with our research into it, we're doing things like obviously semantic search. So I have a client, I have a corporation, they have dividends. How do I do that? Show them. We build a cash flow graph. Why are there deficits in 2040? I don't understand. The system would be able to recognize speech back and go with it. We can do things like we actually use the generative AI component to say, summarize this financial plan for me. And so in that case, it's coming back in a readable text paragraph that can be presented to the client, contextual again to the client's situation, and the advisor can edit it and provide that as advice delivery. And then our whole strategy approach that we've built to the engine that's working today, which is itself another form of AI, to a degree, that we can leverage ChatGPT, well, large language models really, and generative AI to be, my client is 40 in Ontario with 2 kids. This is what they have, help, right? And there's opportunity there for the system then to construct the basis of a holistic financial plan, and then have the professional go in and augment. And the time saved for that is significant. So that's where we're looking at the possibilities of AI, generative AI, large language models to make things more efficient, to get more financial advice to everybody that uses our software.
Only consultants, VCs, and people in management ever think that technology is going to replace financial advisors. Yeah, because if they understood what they actually did, they would never say that. And I go off about this all the time. Just a quick side note. At the end of the day, that is thinking of their people as a commodity and the actions that they are doing as a commodity. And absolutely, commoditized, repetitive things can be displaced by technology. What will not be displaced is the need to take and understand the output of what the technology is telling us and bridge the gap between the technology and the human being sitting across from you who does not have the subject matter expertise to basically comprehend why those recommendations made sense. The future of financial planning is basically all the heavy lifting and work we do now done digitally, quickly, and focusing on behavioral finance and financial therapy and implementation as basically as how we make that become a reality.
Coaching,
Coaching.
Coaching, it's a huge part of it.
yes.
So I want to just talk a little bit about what institutional investors do and what lesson I'd like to draw into the area of institutional investors and in particular more fundamental questions. For example, the capital market assumptions. You know, you spend months and months at CalPERS. I've worked with many large institutional investors. That's like critical for a future, especially long-term models. How do you set the capital market assumptions? How do you take the past and try to project into the future and get some kind of consensus about it? So that's one set of questions. A lot of time, months and months and months, bringing in consultants in, just goes on and on and on. The second question, which is even more fundamental, is what are the asset categories you pick? If you look at university, we did a study of the top 50 university endowments, and the categories are just all over the place. You look at Duke, you look at Berkeley, very different asset categories. What asset category, and they try to play to their strengths. So Duke has commodities, and they have all different 3 or 4 different kinds of commodities, hedge funds, all different kind of categories. Other places very different. It doesn't seem like you should have the same asset categories to play to the strengths of every individual. Some people can invest in certain amounts. How do you do that? How do you set the asset categories? You know, learning what institutional investors do. Can we draw any lessons for individuals? And in particular, the capital market assumptions, which again, you say you use historical data, but you're going forward. You don't want to just use like the spread that the equity market did, or how do you go about that?
So maybe I'll take like how, so for our tool itself, we basically built an agnostic model that firms can provide their own data. So we get everything from capital market assumptions that are historical based. So like FP Canada, for example, we'll put those rates into our system if that's someone wants to use to project the plan forward. And really what it comes down to in my world, it's just we need a derived return rate to project the assets forward to do the 40, 50, 60-year projection of the financial plan. So how firms provide us that data is configurable and up to them. We do want things provided to us arithmetically, and then we actually do a geometric calculation in our application to do our portfolio math to come up with the return rate that's used for deterministic projections. But we're not in the business of necessarily coming up with the data itself. We get from data providers like Tech or Morningstar, things like that, or up in Canada. You're probably better suited to kind of.
So, no, go ahead. I'll go after you.
Look, we all know that all capital markets assumptions can be wrong. Full stop, right? We're making an educated guess. I think what's more important on a retail level with clients is testing for failure. Is basically the stochastic models. It's the crash tests. It's the what happens if you underperform the rest of your life. Like what is the minimum rate of return you need to basically do? So I think it's great that we show these educated guesses, but it's really the stress testing that matters the most. Is making sure that they have a plan for that. And then Pauline, I'll let you address the asset class. I figure this is your.
Yeah, for sure. I guess being the institutional investor. So, and we've had our university pension plan has had one of the top 10 rated by consultants. And I think the one thing that I want to point out the most is that in my 20 years as an institutional investors, the membership had never complained about upside risks. No one comes. I mean, our target return, we have to meet 6%. In order for our pension plan to be solvent, to pay everyone pensions. Nobody has ever complained that we were 1 year, generating 7%, another year 12, another year 10, another year 9, because we're meeting the 6% target. So I think the most important thing, yes, there are the capital markets assumptions and based on long histories or whatnot, but the most important part is managing the downside risks. And so I think that, and that is certainly something that I try to bring to the wealth side as well. And because you can kind of be pretty, I mean, okay, when there was COVID, right? I mean, those are unexpected large events. But I think that if you manage the risk well over time, and that the way you put together the asset allocation can in general meet, for example, for us, that 6%, I think the risk management is more important than the returns, and we have the benefit of having this sort of infinite plan that lives on forever, right? So, and that's one thing that I really find.
But if I can add a little bit, I kind of sympathize with John on this one. Having before starting Digit, my 2 previous companies, we serve the largest hedge funds in the US, the largest investment bank. And I think there's a huge gap. I actually think that individual investors and families, if they're not on some of the wealthiest multifamily offices, they are at a big disadvantage. I think the methods that they use, the investment opportunities that they have, and the sophistication is actually behind. You go to a hedge fund and you ask the hedge fund manager, can you tell me how exactly you make money? They can do that. They know the exact attribution. They know exactly what happened, and they know how, not only how much money they made, but exactly why it happened. And you go and ask the same to many wealth managers. I don't want to generalize, and I don't think the tools are there. Which it doesn't mean that they need it to explain. But I think that will change. I think that there's going to be a lot more of institutional tools coming in, like things like private equity portfolios, etc. But to do that, you need to have the right tools. You need to understand liquidity. You need to understand a lot of things to use it in a more precise way. But I actually think that wealth management firms are at a disadvantage investing compared to many of the bigger institutional guys.
But just to piggyback off that, I think the real issues around that, and I'm going to address the alts situation across countries, right? Canada, US, very different situations.
Sure.
So the reality is that the two things, institutions and individuals are not the same, right? Timelines are different, needs and whatever. So we have to reflect that. But the bigger thing is that this also comes down to regulatory barriers and barriers of scale. Right. So the regulatory barriers, frankly, and opportunities, well, but the regulatory barriers, some of this stuff cannot be done in certain ways for retail investors. So that's the first barrier. The second barrier is basically, getting a client who's only got $100,000 to invest into a reasonably priced, valuable, valid alts portfolio, or at least a segment of it. By the time you actually break down how much is actually going to go into it, you just don't have any access to the market, right? And there's definitely a skimming aspect of this, in that the best deals do not get down to the retail level. The retail level gets a lot of the dribs and drabs of what's left over. So a lot of what and then I'm talking about the maturity between Canada and the US. I was just at a conference where I was talking to people very heavily in the alt space, and some of the stuff that they've told me about and that I see out of there, it's like, okay, very mature market. You guys are pricing this reasonably compared to what I'm seeing here in Canada. Expensive, geographically concentrated, a lot of the dregs, and we've already had massive catastrophes of alternative companies blowing up. We have a regulatory gap in this regard, right? So there's a lot to be skeptical of, depending on where you are, the maturity of that market, and the accessibility of that market. Because again, it's not that, we can get a global ETF for like 8 basis points, right? But when we start talking about, I can get you this alternatives thing that's heavily focused in one geographic region in Canada, unfortunately. And yeah, the return profile looks good, but also now we're taking 3 and 20 and with no high watermark. And you're just sitting there going like, you gotta be kidding me, right? So, and then in addition to that, if you don't feel comfortable in the regulatory oversight of it, how does a retail advisor actually do that in good conscience and actually live up to be a fiduciary?
I could add to that. So I can tell you that we have in York University, we're one of the first plans that started to invest in infrastructure, and that was in 2007. So with 20% in infrastructure asset allocation, we spend 60% of the meeting times on those funds. And the money is constantly coming back because we're LPs, right? Those are closed-end funds. And so as they divest of a project, the money comes back and we have to reinvest that money. And it's very onerous. So, and then also another thing is that if a manager tells us that they're now opening their fund to the retail market, and we'll say, no, what is the reason? That's a negative signal. Right.
It is, because there's only so much opportunity in those markets, and they get swallowed up by the institutions typically. And then if you go down the retail level, I mean, it's a lot easier to convince a pension fund to invest $10-20 million in one, with one, exactly, versus let's go do this at $25,000 a pop. Like, and then you got to compensate the advisor for it. So there is a real challenge in making it diversified enough, scalable enough, affordable enough. And then there's the regulatory aspects to it. So I've largely stayed out of the alt sector in Canada because of the level of immaturity I believe exists in it. If I was in the States.
So let me be a little bit controversial here, because I think people would have said the same about indexing and the ability for people to invest in indices in the 1960s. I think that was exactly what people would say only the largest guys could actually create a 500 company portfolio to do that. And so I actually think that financial innovation, like we have the tools and we have a lot of these things, and there's actually, I understand the regulatory aspect of it. It has to be well controlled, and you could even start with large enough accredited investor groups like high net worth, and this is happening. But there's no reason why you couldn't create not exactly an ETF, because an ETF gives a lot of liquidity. Actually, what you want to benefit, for example, is if you want to create 40, 50-year plans for individuals over time, you want to have a staggered thing. You don't want to pay for liquidity. It actually makes no sense, in my view, to be investing everything in things that are massively liquid. Just you are paying a liquidity premium if you have most of your money in there. I'm not saying you don't need to have a well-diversified. So I would argue that a really well-diversified portfolio over a very long period of time, there are tons of benefits to that, and I think we could create that, and I think that that's going to happen. I think you can see it. I know companies today that are trying to create some of these things where some very large, either retail, probably geared first toward high net worth clients, would do it in a good and responsible way, and there's tons of value to be added.
No, look,
if those opportunities were there.
I believe that market will mature. I believe that market will grow up. I believe that market will be regulated. I believe those costs will come down. That will happen. But it's all about where we are on a growth curve.
Oh, that I agree.
And that is my primary concern right now, especially in this country.
But I will argue that you need the tools to then be able to measure risk properly and to do that. And I think that hasn't been available to those. And I think that's important.
This is lower risk. Well, no. You're just
Exactly.
not pricing the risk daily. Thank you very much.
Questions from the audience?
Thank you. So just continuing off what you were talking about just now, what's the scale of the market in the US compared to Canada about, retail level?
In terms of like investable assets or the alternatives market?
Both, but mostly.
More than 10x. I don't know the exact numbers, but substantially larger. And you got to remember that the US is also near unique in that it is is the regime that pushes people into basically financing their own retirement through 401k plans, right? So DC plans DB plans are really not a thing there anymore. So they are, a population more heavily dependent upon markets than everyone else is for self-sustaining. So it is substantially larger. And the alts market, I don't have data on this. I just know what I've seen in terms of the maturity of that market, the deals that I've seen brought forth in that market. And it's I feel like I'm watching amateur hour in Canada in comparison.
So go ahead.
You know what we have a lot of though? We have a lot of ETFs and mutual funds per capita. It blows my mind.
Canada.
Well, and advisors, but that's a different story altogether.
But the US market, I'm throwing some numbers, which I'm sure are a little bit out of date, but the wealth management market is about 100 trillion in assets in the US. It's probably a 15th of that in Canada, somewhere around that. What's fascinating in the US, and I think it's a big trend that is changing, that is starting to happen in Canada more and more, is there's about 35,000 what are called registered investment advisors, or RIAs, in the US. So these are independent advisory firms that work there, and 35,000. In Canada, there's a few hundred maybe in there, but that is changing more and more. And I think that probably is something interesting to be.
Yeah, and I know the space well, and the reality is that the barriers to entry in Canada for the same distribution channel are substantially greater. Now, there have been changes. That's easier. I actually happier with the higher licensing standard we have here. Great. But what was really missing, and way to set yourself up, Dan, was the reality is that there were tools. The tool landscape was non-existent. In the US, you had the likes of Orion and InvestNet and other players where you could go get a platform in the middleware layer that would take care of all your base level needs at a rate of like $2,000 a month. Didn't exist in Canada.
If you wanted to go independent in Canada, like what do you get?
You have to cobble together your reporting, your portfolio man. You have to do it all yourself while simultaneously trying to start a business from scratch. Right. So it's still a challenge. It's getting better. And I think that, yes, there are software players who are going to help do that.
Yeah, technology is definitely a big driver of that. Yes, Stan.
How do you incorporate in your financial advisor software increased life expectancy? When I teach students, I say that I belong to the last generation who must die, and you are the first generation who will be able to live in forever. So, I'm not promising that's what I expect, but anyway. So basically, financial advice which you will be providing should be like perpetuity, which should run forever. So how do you address it?
So, yes, that was a challenge in previous software. What we did in Conquest specifically is we've added 2 ways to kind of look at longevity as a risk. So the first, well, 3 ways really. So the first way is you build a plan. We use kind of, I guess, right now, a reasonable number to say people are going to live till 90. And there's some wiggle room in there. We're working on putting in some actuarial tables to say, based on where they live and how old they are, what's a reasonable age to use deterministically. But then we have a couple different modules in our application. One's called a what if, which is essentially a deterministic stress test module. And in there, the first one that comes up is, what if you live longer? And so it takes a plan that we built deterministically. It looks at the current plan as well, and basically says just something as simple as if you live 10 years more, you or the spouse, and you can control 10 years, 15 years, 20 years, you can create as many of these as you want. How does your plan hold up deterministically? And more times than not, it fails, right? Because you're running out of income and all we have left is CPP and OAS. We didn't stop there though. We built in this concept of reactive and proactive strategies, which is, again, the AI engine kicking in going, have you considered reducing your spending? Have you considered downsizing your home and freeing up some capital? Have you considered getting a second job, but not at 90, but more specifically, have you considered more fixed income in your plan? So whether or not that's reallocating your portfolio or exploring annuities, those 2 things that you can then apply. We have found, and feedback that we get, that makes it a much easier conversation for the advisor to have with a client, that if you're going to age out, put some protection into your plan, because most people just assume a certain age and you run out of money and then they're wondering why they're in the worst nursing home ever made. The second thing we did was within that volatility analysis I mentioned before, our stochastic analysis, is it's built to essentially show running all of these trials based on the returns and all the market simulations we have, and to show in most cases, the more risky the portfolio, the more it's in equity, the more aggressive the portfolio. We've seen the numbers basically come back that you could just see catastrophic failures at the end of the plan. And all you do is you just inch the age up a little bit and it's even worse. So we're trying to provide better visuals for the challenge right now is most clients just don't want to talk about it. That's the biggest issue. Like no one wants to know that they're going to die. And even worse, no one wants to know that they're going to potentially live longer than they think. And so we're trying to provide visuals and use passive words like, what if someone passes away, or what if you live longer, and all these things, and bring these into the plan, and then focus on strategies that the advisor can incorporate into the software. So that's how we've been changing it.
Yeah.
I think, Stan, you're not accounting for our kids that are going to kill us. Well, also it's starting to happen. There'll be just different ways of like people, there will be murder.
Yeah.
It's one of my inheritance earlier.
Yeah. I'll also add that one of the first myths we have to kill is this bounce the last check attitude, which I basically always say, look, if you're bouncing the last check, it better be for the bullet and the gun. That's it. The reality is you get the plan to basically die with a lot of money. If not, you don't have a cushion. That's it. But I will also say I've not had to plan for the singularity yet. However, I will say if we're going to live forever, we're probably going to work forever. So trade-off, that'll...
I think there was a question in the back. Yes. Alex. Oh, okay. Sorry.
So first a comment on the AI. This is probably the best answer to AI that I've heard in the last 2 months because of the buzz. So thank you for the frank response on to that. I feel your pain, Dan. I mean, everybody's asking about this thing, but I would just say the hope is that this is probably like crypto. 2 years ago, your crypto strategy. So probably we'll go away
until your AI is
that was my next question.
the blockchain. That's going to really get you.
I was planning to spend half of the panel today on crypto, but we're running out of time. Sorry.
But it's the thing that you guys were talking about, the controversial question. You said it's controversial about these either privates or alts. So I want to spend a little bit more time on that because I don't think even it's a Canada-US situation. So we just saw a slide on the hedge fund strategies, and the only one that has stood out and was actually diversifying in times that matter was one, right? So so I think that's on hedge funds. That even doesn't include 320 no high water mark stuff. Like that's highway robbery. On privates, I would like to say that, or ask the question to the panel, is that do you really think there's a liquidity premium here? I mean, CleanFastness AQR say liquidity premium actually is negative today.
Yeah.
So what's the advantage of putting private equity into retail portfolios?
I'll just say that I'm very familiar with Cliff's work. I love the term volatility laundering because I feel like I come up against that in that industry all the time. And yes, I've seen multiple studies that show that there is potentially a liquidity discount now, simply because the preference for
Has gone
as
the other way.
exactly. And I think it's like I wouldn't be. I think in any market that's the same thing, right? Things become overvalued or undervalued based on preference. And maybe we're going to see a private,
That is absolutely.
basically cold winter for a couple of years that'll snap people out of it. But the reality is that I think he's probably right. I think that maybe it's now, maybe it's at some point, but we will hit a point where the preference for privates has hit a point where the actual expected rate of return is lower than that of public markets. And then we'll hit some sort of equilibrium point at some point.
And I just want to add one additional thing. I mean, as much as I was arguing for argument's sake on one side, I think this thing about privates and private equity, it's not an asset class. It's not one asset class. I think we're grouping many things, like there's commercial real estate and residential real estate, not perfectly correlated. There's actually true private equity companies there and funds there. So there's 4 or 5 categories at a minimum, which are very different from each other, like hedge funds, which are grouped in the alts. Like they're not correlated at all with each other sometimes, or they may be. So I think that doing it right means really looking at the detail, and not because everything is private in the sense that it's not getting valued, etc. Grouping it as one group is actually very misleading too. So you have to go and do the details. I mean, when they ask me, do you have a private equity risk model? My question is, well, we have for some asset classes, but there's not, it's not one asset class at all.
Yeah, I guess it was not said enough about ChatGPT, so I will ask another question about the AI. So basically,
let me see what ChatGPT wants to answer.
Yeah, exactly. I consulted ChatGPT before. In any case, so some 5 years ago, we called a chatbot for retail portfolio selection, and it basically what it does, it extracts the investor preferences towards a portfolio, and after it transforms it into a computational problem that we run under the hood, and after that we present back the results. Now it's so much easier with ChatGPT, basically. So essentially, maybe replacing the user interface, especially for the robo-advising type of setting, essentially extracting all what you want, transforming it into the pieces of the computational engine that will run underneath. And after ChatGPT can actually interpret the results back to you and explain what is scenario analysis, what are the downside risks, and so on and so forth. We tried it. It works pretty good, especially with GPT 4.0 API. You can automate, you can actually validate the results. Of course, you cannot trust it, but here we are not really asking ChatGPT to make decisions. We are asking it to, which is much easier. So do you see it as a new user interface in the future and as an interpreter of the results back to the user to kind of get a stamp? Yes, that's what I really want.
I'll go quickly. To a limited degree, I remember the hype around voice assistants being the new user interface of technology. Look, I don't think that there is one killer app. I think the ability, a keyboard and a visual definitely is helpful. A keyboard and a visual and touching is definitely it. I think this is another option, quite honestly, and there will be those who prefer it versus not. So,
yeah, sure. I think it's there's opportunity with what we're doing. It's going to simplify the user interface significantly. As much as I think it's going to help the advisor, we're actually excited to put it into the client interface. Because the biggest problem we have, we've dealt with pension firms, we deal with financial advisors, we deal with tons of people in our company. And when it comes to client facing technologies and this move to clients want to have more touch points on their plan, The biggest problem is they say that, but they're actually scared because there's a huge financial literacy problem. So including ChatGPT and just like large language models, like think of someone who's at home, who's 50 years old, they never had a financial plan, but they can open this thing up and they can just talk to it and explain what's going on. But more specifically, it could tell them the stuff they don't know. Like, I don't know how many times I've talked to advisors or talked to people who have financial advisors, and like, let's call it like 90% of advisors on the up and up, 10% are shysters, right? And they're going to sell you the annuity without knowing a thing about you. Now, think of the value of someone going through this interface and building stuff in, and the client could actually ask, what is an annuity? Why would it make sense to me? And then they go to talk to the advisor because you still need this coaching aspect of it. But now it's almost a peer-to-peer conversation. So where I see ChatGPT is it can close that literacy gap that we have when people are building plans.
What is your problem? Why is whole life?
Yeah. Why do I have no money? Because you live to 85 or live to 95. Yeah.
Especially looking at other countries, so I mean.
Well, 100%.
I'd like to see it happen in Ukraine. Because
Yeah.
Nobody's really invested.
Well, it's
100%.
you mentioned,
Before this, I had a call with someone who's basically being contracted by a bank out of Africa that services 11 countries. And that bank wants to bring financial planning to the African continent. And South Africa's got a great financial planning base, but you go further north, they don't have it. And I'm sitting there going, okay, well, this is a staggering task. Like, I mean, you don't have the curriculum, you don't have the bodies of knowledge for certifying people, you don't have the HR to train them, you don't have the systems to support it. Like, this is a greenfield opportunity. And I think, those types of solutions, which are going to be needed to train the very green advice. I mean, one of the things you built in as well was the financial literacy piece, where you can actually do a step-by-step. This is why you're doing the strategy. This is why you're doing the strategy. That's not just valuable for the end consumer. It's valuable for training the green advisors as to, okay, you're recommending this, why? And maybe I'm old enough and gray haired enough to know that, okay, that makes sense. But if I'm not, I can, you go deeper into what you're recommending to say, okay, well, how does this impact it?
The biggest strategy where I see value as an example is delaying CPP, right? Everybody's like, what do most advisors tell you in the news? Don't delay your CPP. Take it when you get it. It's free money. No, you worked for it. Do you understand if you delay it to age 70, if you can, especially where there's longevity risk nowadays, it's 42% more. Never mind. Oh, yes, 50%. You're right. And yeah, I would forget the YMP. Yeah. Anyways, so that is something that nobody knows. But one of the very first things that we did in 2018, which I think is really helped us get the funding and we need to get off the ground, is we mathematically showed that if you have sufficient investments to fund your plan from 65 to 70, use your investments, control them the way you want, delay your RIF, push CPP out, and you can control your taxation. You control a bunch of things in there. But you say to most clients, they're bird in the hand, got to take it. No, but there's inherent value in just explaining. And so our strategy actually came back. It says delaying your CPP gives you this benefit, and your plan is well suited to delay CPP because of these reasons.
It's funny, you picked on something that actually has a lot of behavioral aspects to the country, right? So one thing I've noticed, this is kind of a sidetrack, is that in Canada, the attitude is that I paid for it, I want to get it, it's mine. Whereas in the US, is I don't want the government having, I can do a better job with it myself. Like it's very indicative of levels of trust of the government. Like it's very telling. But yeah, it's taking away that behavioral cue and showing them the logic and the quantitative math to say you're better off by doing this.
I think we're gonna get queued.
So here was another question.
We've imposed a lot on the time of our.
We're not paying them extra, don't worry.
Other people get paid.
Talk to David, okay?
Statements or anything?
Any last question, or we can wrap it up? Okay, there's one more question. Yes. Let's do that.
So with all these changes in the industry, how is the work changing for new people who are coming into the industry?
Look, there's always this is the way it was. Like, there's always a gap between the understanding of, I'll pick on the 60-year-old advisors and the 20-something-year-old advisors. The reality is that, especially in Canada, less so in the US, but it still applies in the US, is that those people came into a world where they were salespeople, and then advice evolved around them. Whether they evolved or not is their issue. The younger advisors I meet are far more purpose-driven. They don't want to just be salespeople. They actually have been sold that this can actually help people's lives, and they are very much more driven by by that purpose and by helping people. Now that's not universal, of course, but it's not. And the thing is that this technology is supporting their future, not the past. And the old advisors care more about distribution sales, and it was working for them for 40 years. It doesn't really matter. Damn you for taking away my deferred sales charges, blah, blah, blah. But the young people advisors are the ones who are going to basically embrace this. And I see embracing this from the conversations I have. It's okay. So this takes all that ridiculous work I was doing before, makes it a couple minutes and a couple button clicks, and allows me to actually spend more face time with the client and actually start doing all these broad things I was told I could do, all these things that I learned in the CFP that I can do to enhance their lives. That's going to take all this time. So I see more of the nature of the work is changing, but it's also feeding into the difference in desire of the people coming into the industry. And they're really feeding off each other.
And I'd like to think that technology in general is helping attract and is going to help attract a completely new kind of advisor that, as you say, will be completely technology literate, will be completely quantitatively literate, and with a goal of engaging with their client. And I wanted to ask a question on financial literacy, but we're out of time. I think that is a huge role for financial advisors.
Clients of advisors. Because when we were running our beta, there were about 25 retail investors, and you wouldn't believe how, I guess I didn't realize how knowledgeable they were, and they were older, and we had beta testers that were in the 70s, 80s, and it was amazing how much they were open to using technology, aggregating their accounts, all their information in one place, and saying, well, why don't I see this from my advisors? For one insurance, this is my best example, is that my sister has a portfolio with 11 value funds. What is your net asset allocation? Because one's with the 60, 40, so I think a lot of it could be in driven. You might all be clients of in this space, and you can drive the change.
Thank you. So I'd like to really thank Ken, Jason, and Pauline for your time and for a really, really engaging roundtable. And thanks everyone for staying here. Thank you.